Hello, it's Mark with Semantics Research with the Daily Report. So we've seen a decent sized material rally on the ES today as it appears some institutional money is buying and this is not just short covering. This doesn't mean that the pain is over, however, as it could be different players having their own plans or time frame and they can be positioned for the long term. The Fed has stated recently that GDP is not a good indicator in this case, as GDP is contracting, but the GDI is showing a massive acceleration of business activity still. Bullard is saying that the GDP should not be used as a reference point as it has a statistical discrepancy, and rather the GDI reflects the observed labor markets and suggesting that the economy is still growing strong. But this is likely the Fed trying to ease the panic and ignore all the early indicators that we are seeing economic contraction. And this is not ideal because, it does mean that the Fed has no reason to stop raising to deal with inflation. And as a result, you're seeing rate hike odds for 75 basis points for the meeting is still very high. And with this reason, this means that wages are still up and people will continue spending and will not see demand destruction sooner. One positive thing is perhaps that if you just go by the GDI, that the corporate earnings could potentially weather the storm and not contract as much as people think. And the formula for GDI is wages plus profits plus interest income, rental income plus taxes, minus production and import subsidies plus statistical adjustments. But again, regardless, I think this is just one of the ways that the Fed is using to ease people who follow one-way indicators and data. And in my opinion, it does not make any sense to disregard GDP, as it is generally a more reliable indicator of the economy than GDI. Now, if we take it to the yield curve, we are continuing to persist in inversion territory, which means that the bond market is pricing in a recession. And just looking at the leading indicator, it is likely that we will see recession and we do have to note that the market does bottom before the economy. So perhaps taking a contrarian approach and a speculative approach, sentiment is super bearish, and a lot of the bad news has already been priced in. Sure, there could be some black swan or unexpected headwinds that drive the market lower, and it is possible that we are at peak fear and the bear side is quite crowded. A lot of analysts have been calling for the downside, at least from the hedge funds, and we are starting to see some risk on from the smart money in the past recent week, but it is hard to say whether or not this will continue. Now, we are approaching this from a different angle, and it does appear that we do live in an age where information is easily accessible and widespread. In previous recessions and bear markets, we have seen slower pace and more panicked downturns, and perhaps this is due to the fact that we haven't had such of a wild bear market where we had face-ripping rallies and extreme panic. Is due to that we have widespread access to data, and a lot more people are aware, and that we will have a good chance of going into recession. In the past, people were not as aware and they just rode the high tides. Nowadays, people are much more aware and much more alert as information is spreading through wildfire through social media and other platforms. And it seems like everyone is pretty much bearish lately, and as a result, they went cash or sold. And it appears that this year we have seen smart money who have sold early and heavily and bought energy and commodities, but now it seems like that trade is getting sold off mostly, and as it potentially rotates to the next sector or asset class, we must keep a very close eye. From a technical perspective, we are still in a market downtrend as we have not broken this yet, so I wouldn't be that eager just yet. But looking at the commitment of traders report, it seems like we're at max bearishness for the market and we are quite overcrowded on the bear side. This is historical bearish positioning for the markets based on the past data, and it is different from the start of the year where people were very bullish positioned. Also, we take a look at the Eurodollar futures and the Fed Fund futures. It says that we have a good chance of a rate cut mid next year, and as we get closer to that, that is something that participants will look at. So I think in the medium term we could get a decent rally, although this is a very speculative statement, so I would not position yourself in this if you're not willing to or if you're risk adverse or you're still waiting for more of a confirmation. So you don't necessarily have to chase here, and it's really harder to say what will happen in the longer term, but at least in the current moment, it seems just fine. From a valuation perspective as well, there are a lot of risk stocks that are at great deals, and if one was to do a discounted cash flow model, you could see a lot of quality tech is quite undervalued. It's really not a bad time to start buying for extremely long term, and you could dollar cost on the way down if of course that happens. And I would say, if you had like a 5 or 10 year time frame, it seems like great prices to buy from a long-term perspective. We are also seeing small caps have been leading today and commodities caught a bid, which is why we have seen the bond market sell off today and the rates have risen because inflation expectations are a bit higher as a result. And it appears that oil came surging back today as recent steep sell-off appears to be due to speculators or some big players getting liquidated. And there are also rumors that in Texas that the Texas government may tell refiners to stay idle or derate in order to avoid residential blackouts during the heat waves. And if you look at the dollar, it is making historical highs and is extremely strong versus other currencies, which is due to the U.S. being a safe haven in the world as the world economies contract. It is likely that the U.S. will feel the economic downturn the least, except for a few exceptions in the world, as you could say the U.S. is the cleanest shirt in the pile of dirty laundry. And as a result, people are likely running to the dollar as it is the most liquid and the most dominant. And you may see some European capital go into the U.S. equities as a result of the massively deteriorating situation in Europe relative to the U.S. And with that being said, this is it for today's report. I hope you all enjoyed.